Hi everyone, welcome back to the Fisdom Wealthpeek. Today with us we have an extremely interesting guest who's going to be talking about an extremely exciting product and a segment that most of us have been quite intrigued about since quite some time. So today with us we have Mr. Ashok Kanawala. Ashok is a chartered accountant, ICWA and an LLB. He has 30 years of rich MF experience. Currently, he leads the product and alliances effort at HDFC Mutual Fund. Ashok, a very warm welcome.
Hey, thanks, Nirav. Thanks, Fisdom, for this opportunity. And good morning to friends.
So, Ashok, before we get right to the topic, I need to really ask this question: why index investing at all? Today, we are seeing there is an absolute flurry of investors who are switching to index investing. So, is it because active investing is dead, or is the potential of index investing yet to be harnessed? And now's a great time to enter in such a segment of investing.
So, index investing over the years has grown in size. There's no doubt about it. Now, roughly as of the June end, the index or ETF or a passive investing corpus is roughly around 11% of the mutual fund industry. Now, what has happened in last 3 years? Because of extreme polarization in markets, the actively managed funds had underperformed the leading benchmarks like Nifty 50 or a Sensex. And that led to people considering passive investing as one of the avenues to invest. Because, of course, it is very simple. It's a very disciplined investment approach, and you know where you are investing. So, there is less involvement from the fund manager in terms of active selection of securities, and therefore, and of course, indexes are widely tracked, and therefore it becomes easier for people to invest in the market following index investing. What index investing does is a very simple thing where you construct a portfolio which replicates performance of the underlying index. The widely followed index Nifty 50. So there are 50 stocks, and if I invest in Nifty 50 index fund, that means I will invest in the 50 stocks in the same manner in which Nifty 50 index is constituted. Therefore, my returns over a period of time will match the returns of the widely followed Nifty 50 index. And therefore, index investing has become popular with some of the institutional investors also. And now HNI retail investors also have been looking at it. And world over also, the passive investing is gaining some grounds. And if we look at world markets also, a large portion of investment is there in passive investing. So passive investing, one can say, has grown over a period of time. And there are merits of investing in passive investing or index investing as we understand.
Absolutely. And there is also an added cost benefit, right? So passive funds, index-based funds are typically cheaper than the actively managed fund. Is my understanding right?
Your understanding is right, and there is one simple reason because, as I said, that there is a less involvement of fund manager in managing a index or a passive fund. In an actively managed funds, the fund manager has to shortlist the scripts and invest. So there is an active selection of securities according to the investment objective of the scheme. Here, the investment objective of the scheme is exactly to replicate the performance of underlying index, and therefore there is not any leeway or much leeway for the fund manager while constructing the portfolio. He just supposed to replicate the underlying index, and therefore outcome is also sort of you can predefine or predetermine whatever is the outcome of underlying index is the outcome of the index fund, and
Right.
therefore the costs are slightly lower.
Understood. Understood. So, Ashok, one very important dilemma or confusion rather that most investors face is there are many AMCs offering many index funds, all of which track the same index. So, how does one decide which index fund to invest in? For example, there are many AMCs tracking Nifty 50 in one of their funds. But then, how does an investor make a choice as to which AMCs, which index fund should they pick?
Very good question, Nirav. So when choosing an index fund, you need to look at two things primarily. One is the experience of managing an index fund, and secondly, tracking error. Now, what is a tracking error? You have an index return and you have a scheme return. The variation between these two is the tracking error. Definitely, lower the tracking error, better for the investor. So you look at the tracking error of the fund manager, and lower the tracking error gives credence to that fund manager in managing the index fund, and therefore that can be preferred over other options available.
Right. Understood. So now let's get to the most exciting part. That is HDFC Mutual Fund is launching an equal weighted, Nifty equal weighted NFO, right? So the most important or pertinent question here is, how is Nifty equal weight different from Nifty 50? What's the difference?
So the widely followed index is Nifty 50, and Nifty 50 has 50 stocks. Now when you invest in these 50 stocks, there is a weight assigned to each stock, and weight is assigned according to its market cap net of the promoter holding. So for example, if a market cap of a company is 100 crores and promoter holding is say 25%, so the effective market cap is 75 crores. Similarly, for 50 such companies, and accordingly weight of each company in Nifty 50 is decided. So Nifty 50 that is widely followed is a market cap weighted index. When it comes to Nifty 50 equal, it is a smart alternative to investment strategy followed by the Nifty 50, in which there are same 50 stocks, but instead of assigning market cap based weightages, the weightages are equally distributed. So therefore, every scrip in the forming part of the 50 stock is assigned 2%. So whether it is the large market cap or a low market cap, everything is equal, and that is 2%. So that is called equal weight index.
Okay.
So this is the primary difference between a market cap based index, which is Nifty 50, and a Nifty 50 equal weight index. Both indexes are there for nearly more than 20 years, and both indexes are computed daily by NSE. So, or subsidiary of NSE, which we say ISL. So it is the publicly available indices. One is a market cap based indices, weightages, and other is where the weights are equally distributed between the 50 stocks.
Understood.
At the rate of 2% per stock.
Understood. Understood. So, which begs the next question: why create an equal weighted index at all? What is the efficiency, or what is the differentiation, or what is the benefit that it brings to the table versus a market cap weighted index like Nifty 50?
So the benefit is this, that in a market cap based weightage indexes, which is Nifty 50 widely followed, the outcome is influenced by the companies whichever large weightages. For example, the first 5 stocks in a Nifty 50 weightage is really 40%, around 40%. And accordingly, in Nifty 50 equal weight, it will be 10% because 2% per stock, so 5 stock is 10. Similarly, the bottom 5 weightage in a market cap based weightage index, the Nifty 50, is roughly 2.5%. It is going to be 10% in equal weight. So what is happening when a economy is growing and the market rallies are broad based? What we have seen of lately from a bottom of March 20, there is a smart recovery or a broad based recovery in the market where all sectors, all companies are contributing. For last 5-6 years, from say 2014 onwards, the Nifty profit growth rate has been 5-6%, and the market movement has been pretty polarized. So only top 5 stocks actually gave direction to Nifty. The others were not contributing. Now from March 20 bottom, all stocks are contributing. But if a low weighted stock is contributing and it has doubled from its price perspective from its bottom, the impact in Nifty 50 is not there because their weightages are very low, maybe 0.5%. So it cannot influence the direction of the Nifty 50 and therefore the returns. But in an equal weight, every stock has an equal opportunity to contribute. So if there is a growth in 50 stocks across the board, across the sectors, where each player matters, therefore, logically, the contribution of each stock will get noticed, noted, and therefore outcome tends to be slightly better. And we have seen over last 2 decades, equal weight has given on a long-term basis better returns than a Nifty 50 returns because of the contribution coming from these smaller stocks. One more thing is there, which is a unique to this equal weight, is auto rebalancing and profit booking. Typically in Nifty 50, you don't have to do anything. Depending on market price of each stock, every day the market weightages are computed for each stock and accordingly Nifty direction is up or down is decided. What happens in the case of equal weight, because every stock is 2%, suppose some stock has moved up smartly in a quarter and their relative weight has become 2.5%. So every quarter the weightages are rebalanced, so brought back to 2%. So automatically there is a profit booking happening in those stocks where weightages have gone above 2%. So there's an auto profit booking or rebalancing. And similarly, if some stock has fallen behind and weight is dropped below 2%, there is an auto averaging. So this is a continuous process which happens every quarter, which is not the case with Nifty 50. Nifty 50, the price is determined every day according based on market price, market capitalization decided, and therefore the direction of the Nifty 50. Here, every quarter, every stock is rebalanced to 2%. To that extent, there is an auto profit booking or auto averaging. Eventually, over a period of time, the outcome improves, and more so when economic outlook is improving and corporate profitability is improving. For example, as I said, in last couple of years, the average profit growth rate of Nifty was around 5-6%. In a pandemic year, the corporate profitability of Nifty 50 companies has improved to 17%, and the outlook going forward is also promising. So in a scenario where economic outlook is improving and corporate profitability is also likely to improve or is promising, logically, the contribution of smaller weightage indices which are there in Nifty 50 will get more noticed more in an equal weight, and therefore outcomes are potentially likely to be better than Nifty 50.
Fantastic. This was extremely insightful. Who would have thought such a small in the methodology could yield so much benefits, right? It's pretty efficient as a strategy, in my opinion. Makes a whole lot of sense. As we move towards the end, there is one important question that I'm sure will be on top of all investors' mind. So obviously, everyone will do their asset allocation, but within equities, how much should one allocate to funds like the HDFC Nifty Equal Weight Fund?
See, the beauty of this product, as you think about it, is a blended of passive investing and an active management. Let me explain you in a minute. It is a passive investing because I'm going to invest only in 50 stocks in a disciplined investment approach, 2% per each stock. So there is little leeway for fund manager to add one stock or invest in less one stock. So he will exactly do what equal weight index provides. So it is a passive investing first of all. But there is an element of active management because of this auto rebalancing happening every quarter in terms of profit booking or in terms of auto averaging. So to that extent, it has a potential to generate some kind of alpha over a medium to long term period of time. Fortunately, even in shorter term, now the outlooks of corporate profitability and economic outlook both are improving. So therefore, short, medium and long term three are aligned in favor of equal weight. So from a perspective of investor, now how much should we go to equal weight? I would leave that question to investor depending upon his risk appetite and in consultation with his financial advisor. What is right asset allocation makes, that is a very individual subject. Sitting here, I will not be able to comment or give a general answer to this. First of all, how much debt, how much equity, how much gold, that somebody needs to decide in terms of asset allocation depending upon the risk profile or his inherent risk tolerance ability. And having decided on activity in terms of equity allocation, then some portion can always be there to the passive investing, because it is very simple and convenient to implement and understand. You know the outcome because they are widely tracked indices, and there is a less involvement of the fund management. So there is a case for active management also. There is a case for passive, but I will leave that decision to the investors in consultation with their financial advisors. So this is what I would like to say.
Absolutely. So, for the viewers watching this right now, in case you do not have immediate access to the knowledge required to frame your asset allocation, why don't you write to us at research@fisdom.com, and the team here will try and offer some guidelines on how could you go about deciding the right asset allocation framework, and what are the key things that you should have in mind before drafting your own investment portfolio. So, Ashok, this has been quite an insightful conversation. I feel we have touched upon some very key elements of Nifty equal weight as an index and the efficiencies that it brings into the table. I'm extremely confident that investors are going to love the proposition that HDFC is bringing out in its NFO, and I wish you all good luck with the NFO.
And thanks, Nirav. Once again, thank you very much for the opportunity, and I wish good luck to all your investors. Thank you very much.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.